Welcome to Growth and Exit Strategies for Software and IT Companies, the flagship tech conference of the World Financial Symposiums. The GXS conference caters to tech founders and investors in tech M&A, covering topics like investments, growth strategies, buyouts, sales, divestitures, and mergers. Thank you for joining us. Let's begin.
Welcome back. It's time to move on to the buyers panel, moderated by Rob Griggs, president of Corum Group, answering key questions such as, what are tech buyers looking for in today's market? Are buyers only looking for companies that have already integrated sophisticated AI in their business models? And how can you build relationships to capture maximum value?
As we begin today's panel, I want to acknowledge the efforts of the World Financial Symposium and the Growth and Exit Strategies conferences. I want to recognize Anna Conejo, Barbara Mambouf, Samantha Santana, Alex Stout, and the rest of the staff. Prior to COVID, we did these live in San Francisco, Chicago, New York, and London. I've had the privilege of chairing these panels at more than 12 of them, and this panel is by far the most exceptional one yet. We have several panelists with more than 20 years in corporate development, mergers and acquisitions, private equity investments, acquisitions, operations, and sales of portfolio companies. Think about it. Many panelists with experience going back to 9/11, 2002 crisis, 2008 crisis, 2012, 2016, the pandemic, and now high inflation, high interest rate economy. Almost every conceivable business and society environment imaginable, they've worked through it and come out with experiences that just cannot be taught. So I'm extremely privileged to be today's moderator. And now for introductions. Krista, you want to introduce yourself, please?
Yes, absolutely. Rob, thank you so much for having me. My name is Krista Young. I'm a managing director in corporate development with Accenture. In this role, I'm accountable for helping to develop and execute our North America inorganic strategy, which includes acquisitions, divestitures, minority investments, etc. So I'm absolutely thrilled to be here. The companies that we typically invest in tend to be services companies that we would consider to be tuck-ins to our existing portfolio. We never acquire companies for capacity. We are always looking for net new capabilities, strength in leadership, and organizations with strong cultural alignment that can really help to accelerate our growth going forward. Also, just one quick deal that I'm really proud to have worked on at the intersection of technology and AI was our recent acquisition this year of a company called Udacity. Udacity is known for their cutting-edge learning approach that blends AI and instruction, and we were really excited about welcoming the Udacity team members and capabilities to the Accenture family to help our clients with accelerating their learning journey for their employees around AI and the data strategies that bring AI to life. So absolutely thrilled to be here with you today, Rob, and this panel, and looking forward to our conversation.
Great, Krista. Thank you very much. Satish, you want to do a quick intro and some input?
Sure. Thanks, Rob, and thanks for having me. Good day to everyone. My name is Satish Raman, and I serve as Chief Strategy Officer at Fractal.ai. We are in AI's first firm and have been so even before it was popular when we started about 25 years ago. And part of my responsibilities include supporting the overall growth of the company, with inorganic being one of the pillars of that growth, including minority investments and acquisitions. One recent deal that we're proud of, and if I have time, I'll quickly add another one, is the divestment of an incubated company called Raman, which used AI plus quant strategies to make humanless decisions investing in equities. And we were able to successfully transfer that to a rightful owner, which was a prop trading fund that didn't have mid and long-term frequency trading. They had high-frequency trading. And the fact that we were able to develop algorithmic products that could be taken into a hedge fund from a real use case standpoint is something that excited me. So that's just a little bit about me and, one of the most recent transactions that I'm proud of.
Great. Thank you, Satish. Udo, you want to do a quick intro, please?
Yes, hi, my name is Udo Waibel. Thank you for having me and looking forward to our discussion today. I'm with the Riverside company, and I'm managing director for technology and product management. So in my job, I work across all of our portfolio company, especially the technology-enabled ones, and advise them on anything related to their software and technology stack, from in-house development to how to properly run their cloud infrastructure to product management and roadmap topics. As part of this, I'm also involved in quite a lot of our due diligence activities, and we have developed an AI risk and opportunity scorecard that is now being used for all of our new investments going forward. Riverside, especially the microcap fund, generally targets North American investments with less than 10 million in EBITDA. So we're starting with relatively small companies, and we're starting to see in this investment, we're only now starting to see the first AI set of activities. Some of them are still very early stage, where they just use some of the open API-based activities from the known vendors, Google, AWS, and so on. Others are already developing their own data science algorithms and more. So it's still at a very early point, but it's definitely starting to show up more and more.
Excellent. Thank you very much. And Ksenia, please give us an introduction.
I'm Ksenia Desautels. Very happy to be here at this conversation. I'm part of the corporate development team at Akamai Technologies. We are a publicly traded tech company specializing in delivering, optimizing, and securing content over the internet. Akamai Connected Cloud, massively distributed edge and cloud platforms were used by top enterprises globally to develop applications, workloads. I've been with the company for more than 7 years, and I have worked on various sizes transactions in microsegmentations, API security, network, web security. We both invest and acquire companies that usually have such fundamentals as proven technologies, dedicated team, track record of delivering world-class cybersecurity solutions. With regards to the size and stage of the companies, we consider companies in all life cycles, from pre-revenue to mature, well-established, profitable organizations, and we've done deals across all the spectrum. With regards to AI and recent deals, I would say these days, any technology we acquire has some parts of AI tech in it. I do think, however, the market in itself is still early. We are currently looking and making some investments in infrastructure technology, enabling to securely run Gen AI applications at the edge. And as often we are looking for synergetic investments, and as the landscape matures, we will be looking at a higher growth tech that would enable run this application securely with our age.
Great, Ksenia, thank you very much. Now we're just going to open up with a handful of questions, and we'll give everybody a chance to respond. In the discovery phase of looking at and researching, Satish, is there a right time to buy an AI company?
I would say the right time is always now, especially in the context of artificial intelligence, only because of the pace and the speed and the rate of evolution. What AI was in its infancy back in the 1950s, absent all of the available compute, the available bandwidth, the available storage, which has led to an explosion of a commercial and consumer usability of artificial intelligence, kind of just says in an arc of less than about 70 odd years what the art of the possible is. And with each such iteration, there's going to be new sets of capabilities that companies need to bring within, which don't always have to be built, and where there's no luxury of time to go test the market from a viability standpoint. So to keep up with the pace, along with internal innovation as well as development, it's always going to be now, at least for the foreseeable future, as this wave continues to gather more speed, momentum, and size.
Excellent, thank you. Udo, your comments on the right time for AI companies?
I agree with Satish that obviously you want to buy the companies as early as possible. On the other hand, we also should consider to validate some of the basics, which just based on the hype cycle that AI is in, some people just forget about those. And to me, the basics is the market that this company plays in, is that market ready for AI? Some markets are just not ready from an AI perspective yet, where either the AI models are not advanced enough or the end user acceptance is simply not there. Secondly, does the company have access to data, and do they have enough data available so they can train their algorithms and deliver real value? We're still seeing quite a few AI for AI sake kind of use cases where companies just sprinkle some AI on top of their existing products. Those obviously are not the ones that you want to make investments in. You want to invest in the ones that really have a game changer and can deliver the value. And lastly, I mean, does AI allow them to be much better competing with their competitors? Is there a game changer moment in there? I mean, those are some of the basics that people need to really look into and evaluate before making an investment in an AI-based company.
Yeah, thank you. Very, very insightful. Ksenia, your thoughts on timing for acquisition?
I would agree with everything that's been said, and especially with Yuda's point on whether the technology is really innovative, proven, or has some market in addition to it, or as Yuda pointed out, sprinkle of AI. So generally, I think the right time to buy an AI company is the same as any other tech company. It's proven innovative technology. It's solution that is most demanded by buyers, the use cases, or it's the tech that would actually fold into current strategic buyers' portfolio, be synergetic. So at this stage of the landscape, I think it's some niche products and solutions that would build the larger AI story and ultimately product.
Great, thank you. And Krista, your thoughts?
Thanks, Rob. Udo, I really like the term that you used, hype cycle. I think that that's a very ripe term currently when we're considering AI companies. In my experience, what I'm seeing is that the line is starting to become very blurred in terms of what is an AI company versus what is a company that is actively leveraging AI as they transition into the future. And I would say the right time is when you can answer a handful of questions. And those questions to me would be, what is the industry's readiness for AI, and how is AI impacting a particular industry? As we look at a target company, what is the level of productivity impact that we would expect AI to have on this company? What are the commercial decisions that go along with that? Will there need to be large-scale operating model changes relative to the pyramid or how services are being provided? What are the additional investments that are going to be required to continue to build out those AI tools and leveraging AI? And all of these considerations have very material financial impacts to the business case and overall investment strategy. And I think that it's incredibly important to be thoughtful about those elements as opposed to just jumping into the hype cycle of AI.
Yeah, great, Krista. Thank you very much. I absolutely agree. Go ahead, Satish.
If I may add, Rob, to I think at least a couple of the points that Udo and Krista made. I think we need to make a fundamental difference between fairy dust AI, which is AI for the sake of AI, and the true practitioners of AI. And the lines are blurring, but I'll give you an example, a Fractal. So one of the earliest companies that we bought back in 2016 is what is in flavor today. And so when I say the right time to buy is now, it's about obviously evaluating the landscape from those techniques and those capabilities that you as a buying house have a firm point of view on the commercial adaptability and scalability in the future is going to be. Buying it because it's popular today is almost always a recipe for failure, but buying it because it is not yet commercially viable or feasible, but there is a house point of view that it is going to become scalable, adopted, and commercializable is a forward-looking view that we need to take today.
Excellent. Thank you. Yeah, I think the conundrum is inorganic versus organic, entrepreneuring versus acquiring and buying the technology. And all of those require a certain level of understanding, due diligence, market acceptability, and those types of things. So great points, everybody. Thank you so much. I think when it gets down to the deal process and things, starting with Udo, what advice would you give to a technology entrepreneur who's looking to prepare themselves for an M&A process?
Obviously, nothing different than any other M&A process, and that is first and foremost, be prepared. Be prepared that your AI use cases need to show real ROI, that you can prove the numbers, not just make up some pretty spreadsheet. But also then be prepared to have some external consulting companies validate all and everything you do on the technology side, from having a proper product initiation, a product roadmap, a portfolio roadmap, a product vision statement, on all of those on the product management side, but also then your product execution. What is your organizational structure? What is your software development lifecycle? And I mean, we combine the process within Riverside microcap fund that we call the PMAT, the Product Management Assessment Tool, that looks at all of those different aspects to make sure that they are prepared. And when a portfolio company on our side comes up, we more or less dry run that type of a process with them to make sure they are really well prepared for any type of questions that is being thrown at them.
Great, thank you. Ksenia, your thoughts on preparation?
Yeah, definitely being prepared. And I would say always a good idea to start building partnerships and relationship with potential strategic buyers early on. It takes time to develop these relationships, even if you are not thinking of selling this year, next year, in 2 years. It can start off as introduction of the technology to existing strategic portfolio, to customers, building this big picture strategy. So it's both knowledge of your business and technology, and then how it can scale and provide the unique value proposition to the market, given the synergy that you bring to the strategic, and then strategic provides to the target. And of course, being prepared with all technology, financials, audits, very well documented and organized.
Great, thank you so much. And Krista, your thoughts on preparation?
Yeah, so I agree with everything that's been said. I'll highlight a couple specific areas. Number one, I can't emphasize enough how important it really is to be able to have a very plain language overview of exactly what your organization does and the competitive advantage. In my organization, a lot of what I am doing is helping to build consensus within the organization and help individuals understand, who are not necessarily subject matter experts in this particular space, exactly what this company does, what makes it unique, and how we will be able to continue to leverage those assets and capabilities going forward. And I can't tell you the number of times that I've been in one of our board meetings or investment committee meetings, and one of our very senior executives will sit back and say, okay, I heard everything you said, but can you just slow down and explain to me in plain English, what does this company do? So I think that the more that you can be front-footed about having, in addition to the highly technical explanation, of course, which is required, but that really crisp elevator pitch will be incredibly important. Number two, I often see overlooked the data strategy that an organization is relying upon. And the fidelity of data, that data collection process efforts is really fundamental, especially in the context of a publicly traded company with all of the compliance and risk concerns ultimately that we have. So those would be two fundamental aspects that I would encourage sellers to consider as they are starting a process.
Excellent. Thank you. And Satish, your thoughts?
I'm going to take a slightly different tangent over here in the context of a tech entrepreneur, and suggest that the right time to think about M&A is when you actually start the company. Just the way we have any task at hand, we know when we're going to get in and when we want to get out. And it should be always a part of the planning process, even as you found the company, saying, as I build this company over a period of time, depending on the success, the passion, the level of energy, excitement that I continue to have, how much longer am I going to go, but what is the end game? So having that thought process, even as companies get founded, I think is going to be a great advantage, because as you build the company, you can then build your network of potential buyers, as Ksenia said, and do that with like-minded people. Because at the end of the day, all of this comes down to people first. Technology may be great, data may be awesome, market sizing is great, but without both the people being able to work together, the buyer as well as the seller, it often has a lot more friction and value gets eroded. So having the congruence of what the seller brings to the buyer, vice versa, and chemistry between the entrepreneur who's selling and the company that's buying, and an ability to work together, and then carefully building the network out, I think go a long way in accelerating the pace at which you can transact when you make the decision that that's the path that you want to go down.
Excellent. Thank you. I did do a quick intro on myself earlier, but I always explain that I am an Eagle Scout, and be prepared has always been the motto of the Boy Scouts. And I think all of you are correct with your ability to think through. And Satish, having the end in mind is always a good place to start. The other thing that we always try and focus on heavily for, again, the smaller tech entrepreneurs is to look for the potential partners who have a shared culture, a shared vision. They're people you're excited to want to go become a part of a bigger organization and bring real true value there. So I just think the better you see yourself, your perspective, where you are in the market, the better you can find the right partners, get that market fit, market traction, and have a very successful eventual exit. A quick question. We're just going to segue over towards valuation. It's a complex question, but just curious how your individual organizations go about looking at valuing companies. And are there common misconceptions amongst sellers about valuation? Ksenia, we'll start with you.
So, yeah, definitely take it very serious, and that's a big part of pre-LOI exercise. As I mentioned earlier, we do acquire companies from different life cycles. So it could be pre-revenue, very little revenue, or mature companies. We definitely employ the very usual standard financial methodologies like DCF. We look at private and public comparables. However, the fundamentals is the business case that we built. We consider the metrics such as revenue, operating expenses, margins, net income loss, and we would start off with the management case of what's provided, and then look into the synergies of what we bring to the company, and how the target company will benefit from existing Akamai GTM technology platform. I would also stress that on top of everything, sellers do need to be aware of macroeconomic environment, interest rates, funds available to VC. We oftentimes see the decisions made by entrepreneurs do another raise or find a strategic and sell, whether it's early or the right time. So these are questions that need to be constantly debated. But yeah, that's we in Corp Dev look at all of this, and as you mentioned, it's the multidimensional matter. It's more of an art than science.
Very good. Thank you. Krista, your thoughts on valuations?
Sure. What I would add is that it's really important from our perspective to be applying the lens of a market participant. One of the first things that we do when we start getting into evaluation is taking a look at the financials and making sure that we understand, are there unique attributes of how this target is running their business that could not continue post-acquisition? Whether that is a unique executive leadership compensation approach, whether it is a very lean operational structure that may have challenges scaling. That's really the first starting point, is to get that clear view of financials and what we could expect those financials to be as the business continues along its growth trajectory. We do typically approximately 40 to 45 transactions per year, pure acquisitions, and have for over 10 years now. So the data set that we have internally of somewhat similar organizations, similar in terms of broad characteristics like industries, service lines, that these are services companies, not software technology companies, really helps to infuse an additional layer of thoughtfulness over the market data that we're getting from outside sources. The targets that we're typically acquiring tend to be much smaller than publicly traded companies. So while publicly traded multiples are an important test of reasonableness, they very rarely establish the basis for valuation. And the one warning that maybe I have to sellers to be thoughtful about is I can't tell you the number of times that a seller will say, well, here's the multiple that we have in mind. And while that's always very important for a zip code conversation, simply applying a multiple to a number, whether it's EBITDA or revenue, typically that conversation is quite premature because we have not yet completed diligence. So we might not necessarily agree with the characterization of revenue and what is included in that. We may also not agree with the presentation of EBITDA. So that is a very fast way to get into a valuation disconnect, to just be speaking early on in the process around valuations that are coming from implied multiples.
Great. Thank you so much, Krista. Udo, your thoughts on valuation?
No, I agree with everything that Krista mentioned on valuation, especially sitting on those multiples. Right now, there seems to be an expectation in the market that because of all the hype around AI, that companies that have AI built in get an additional benefit on top. But in order to achieve that, they really need to prove their business value. They really need to have a solid plan in place on how they're going to scale it up. And I think there's just a general, let's say, warning or statement to not fall for that hype and to keep it back to the focus back on the basics.
Great, thank you. And Satish, your thoughts?
I think I agree with most of what's been said earlier. I'd start with this is a suggestion to all sellers and potential sellers. Going back to what Krista said is, please don't start with a multiple expectation, only because the fundamental dynamics of each business, the client cohort they have, the kind of work they do, the size and scale that they're at, the geographies they operate in, the footprint of their teams, the maturity of their technology, are all fundamentally different. So the moment something comes in print or there's a public comm, forgetting even about, discount for lack of marketability or liquidity, there is, an implied sense of entitlement to what value ought to be. I'd again go on a little bit of a tangent to answer the question of how we think about valuation. To us, it's simply, what is the price we're willing to pay? And is that price acceptable to the seller who's willing to sell to us, right? I mean, what is that handshake value? In our analysis, we look at what collectively we're able to do with the business. So it's not just what the business brings to us, but what we're able to add on top of it. And then in the context of what the perceived value that we're creating is, how much are we willing to share with the sellers? then obviously we look at the base case of that, assuming many of those assumptions are not going to pan out or work out. And does that match to seem reasonable now in the context of verifiable third-party and market-validated numbers? And the final test is, at the end of all of that, is that going to meet my capital allocation and cost of capital threshold for it to make sense to me? Those would be the ways in which I'd approach it. So for me, it's more of an art, because I can, torture any formula to give me a number that I want, but I don't want to do that.
Yeah, great point. Thank you so much. Just a quick example here. I just a couple of weeks ago put a client into LOI, 2,000 active small, medium-sized businesses. The acquirer has 100,000 small, medium business-sized clients. And this is one of the 3 legs of the stool that they're looking for future growth. So we weren't able to go grab all of that, but it was a great fit, great culture, great commonality. We're going to be closing in 3 weeks' time. So it's that kind of fit and synergy and those types of things where the sellers can target and really bring their best foot forward. And then the buyers get to help orchestrate and determine what the future looks like, because the success of the deal isn't getting to closing, it's what the buyer can do 1, 2, 3, 4, 5 years out into the future. So great insight, everybody. Thank you. Just quick question here. We'll start with Krista, back to you. Just kind of in a general sense, what percent of the transactions make it through due diligence? And what are the kinds of things that would cause a company to fall out of due diligence?
Sure. So to answer that question, Rob, I do need to share just a little insight into the diligence approach that we take. First and foremost, we fundamentally acknowledge that processes are very disruptive to businesses. So we try to be very respectful of business operators' time that we're engaging with. And the diligence process in particular can be incredibly disruptive. So what we tend to do is start with a very high level preliminary diligence request and mutual exploration together that is focused on what are the most material items that would need to be true for us to be mutually willing to continue the process together. That reflects fidelity of financial statements and projections. It also reflects details regarding client concentration and whether the clients are aligned with the types of clients that we have chosen to serve within our business model. Also, details regarding the talent, their capabilities, experience level within the industry, the amount of time that they've been working together, how the organization is structured. And our overall approach there is to hopefully get to a point where we understand the business well enough that we are no longer using the diligence process to determine whether or not we want to proceed with the company. Once we begin formal due diligence, it really is more confirmatory diligence and also quite a bit integration planning. So because of that, by the time we do get into formal diligence, very, very few transactions don't materialize from that process. And the ones that don't materialize, they tend to follow a fairly common fact pattern, which is unfortunately material differences, perhaps, in what was initially presented. Sometimes, unfortunately, certain commercial practices that may be acceptable to smaller companies that are operating in gray areas may not be acceptable within the confines of a publicly traded company. And then, of course, any ethical issues or concerns that come up as we continue the evaluation process. Inclusion and diversity is incredibly important to us as a buyer, and we do expect the leadership of our target companies to be respectful of that and focus themselves on helping to improve wherever they're starting from. So that's a high-level summary, but very, very happy that a majority of our transactions or our diligence processes do lead to consummated transactions.
Hey, thank you so much. Appreciate that. Satish, your thoughts on the diligence process and surviving through it for the sellers?
Yeah, I think the question even of surviving for the buyers is equally important, but maybe not a topic for today. For us, going back to the earlier comment that I made, I think it comes down to a meeting of the minds with the founding team, or the executive or the management team of the target. And the whole alignment from a culture, congruence, chemistry, a consonance from a vision, roadmap, what we're going to do together jointly, I think is very helpful, because that also brings us into the thinking of how they've built their business and what is the culture and the ethos that we could see kind of coming down the other layers of management. For us, any external diligence is only to validate what we have discovered already. It should not be to throw up something new, in which case we failed in our role collectively a team to be able to validate, review, and make certain assertions as to why we should or should not buy. And I think a better way to go about sourcing transactions as we come to think of diligence is to build more of a proprietary book, if you will, of a pipeline of transactions, obviously relying and taking advantage and thanking all the advisors and the intermediaries and the bankers and advisors who bring deals to us. But just by way of one example, over the last 3 years, in each of those 3 years, we've evaluated on average more than 450 transactions, and we have closed on 3 of them. And there's 450 a year, and of those 3, those came from undiligence or fully diligence, almost getting to docs of 4 opportunities. So even before we go full court press into confirmatory diligence, we tend to weed away a lot of those. And roughly about 70% of each of those 450 deals on average are prop, and the rest of it is what comes inbound from the market to us.
Excellent, thank you. I appreciate that. Udo, your comments on the diligence process?
Yeah, very similar to what Krista and Satish already mentioned, that obviously you don't want to burn too much time on deals that don't make it past the finish line. So we try to weed them out as early as possible, to also not be too disruptive to us, but also to the potential company here. Now, obviously, once we get to the LOI part of the transaction, the likelihood of that deal closing is already very high, because that's when they need to make a significant investment. We need to make a significant investment in time and money. And so you want to make sure that once you get to that point, that it is a very high likelihood. Obviously, being a private equity firm, we do have certain playbooks, and we have lots of, let's say, sources that feed into that. And there's a huge amount of deals that we continuously look at every single week, and the numbers keep growing and getting more and more. So, but other than that, seems to be relatively identical to what Satish and Krista already mentioned.
Great, thank you. And Ksenia, your input?
Yeah, definitely can relate to everything that's been said about me. We at Akamai, we a very disciplined buyer. We go through a lot of internal strategy, fit approvals. We engage in multiple management strategic discussions with the potential target. So majority, once we get to the diligence, we already get to know the company and the preliminary business case. So if the company doesn't proceed through due diligence, it's a rare occasion, and usually due to fundamental problem with the business that surfaced during due diligence. That could be misrepresentation of current health or trajectory of the business growth. But definitely agree with everything that's been said before me. It's the LOI, pre-due diligence process that's most important, and once you're past that, it's confirmatory work on both parties.
Yeah, the more amount of work we can do in the discovery pre-LOI, the easier it is to make the confirmatory thereafter and ensure that you've got all the right parameters and metrics and KPIs in place. So great insights, everybody. We appreciate that. Thank you so much. Now we'll get to after the deal is completed. Satish, what does your typical post-acquisition employment agreement look like, and how long do you typically keep key employees?
It's our desire to keep them forever, and I don't mean that lightly. At least in the 7 years that I've been at Fractal, out of the 10 odd transactions that we've done, only in 2 of them have the founders left after a period of 3 to 4 years on average. But we want each of these founders, members of the management team, the KNPs, to build and grow the business along with us. So one of the things that we evaluate very early on that comes into our pre-LOI criteria is what is the motivation of the founding team, or the executive team, or the management team, and have they been largely brought in, airdrop, to window dress, get this thing ready to be sold, and move away within a period of 1 year, in which case we're left with pieces of paper, i.e. a contract, but no reality to drive the business going forward. So we want to create an environment where each of these founders are able to thrive and grow and build the business along with us. And knock on wood, I should say, except in 2 of those cases where people left after about 3 or 4 years, the rest of them over the past 7, 8 years still continue to work in Fractal and work with us in actually bigger capacities and roles than they did as founders of their companies.
Great, thank you. Udo, your comments or thoughts?
Generally, we value the founders and the existing management team and welcome them to stay on. But obviously, as always, it depends. It depends if the deal we're looking at is a whole platform deal or is an add-on deal. It depends on what are their preferences. Sometimes the founder who has run the company for 10, 15 years just looks for an exit to be able to retire. In this case, we want to make sure that there is a proper succession planning in place, that there is a transition plan in place, and that allows them to move on. In other cases, the founders really stand behind the idea, and those are the type of founders you actually cherish and you want to keep on the team. And we've had a number of cases where they even stayed on throughout the entire hold period. So every deal for us is different, depends on the type of the deal, depends on the situation. But generally, we try to retain the management team as much as possible.
Good, thank you. Ksenia, your thoughts?
So as a strategic buyer, we see value in both technology and exceptional talent, their skill set, entrepreneurs, and of course their teams and the culture fit with Akamai. So usually as a result of this, most founders stay within Akamai. They stay in executive roles for a long time. And they come into this roles with the goal to grow their niche product in industry leader products. And as I mentioned earlier, these are the conversations that are very early on, and executives and the entrepreneurs are excited and looking forward to expanding and growing.
Great, thank you. And Krista, some final comments there?
Sure. So I also share the point of view that we would like to keep people on forever, wherever possible. However, we find that it's just absolutely imperative to focus on transparency in the initial stages of the process regarding what do the founders envision for themselves? Do they envision being a part of the leadership team and continuing to help the business scale beyond what it could have done independently? Are they viewing it as an exit? Whatever the seller's ambitions are, we have a lot of different deal structuring tools and various employment agreement options that can really help to encourage their retention through a specific period and enable them to achieve some of their goals if their ambition is not to continue on with the company. But in that case, it is absolutely imperative for us to understand and get to know the next level of leadership and their ambitions. So as a services company, buying other services companies, at the end of the day, the greatest asset is the talent, the people. So we need to be absolutely certain that the talent that is coming over continues to have a leader, continues to have an evangelist for the capabilities and the ambition of the organization. But above all, transparency is really the key element for us to focus on with that founding leadership team.
Yeah, thank you, Krista. Back in November of 2018, I was chairing this similar panel in New York City, and one of your coworkers from Accenture was on that panel. And I now use this every day when I do training around integration and deal closing and going forward. And the comments that he made about the significance that being the biggest acquirer that you are my entire time at Corum in the last 8 years, every year you guys are at the top of it. The commitment that you make to the success of the transaction post that transaction, which is very similar to what everybody else was saying as well. Just real quickly, we got just a little bit of time left. We'll go around with everybody. Any closing thoughts based on our discussion today, words of wisdom for the people in the audience? Udo, any closing comments?
We had a lot of discussions about AI, and I think we can all agree to the fact that AI is here to stay. We actually see kind of the introduction of AI similar to the emergence of the internet back in the late 90s. And we're starting to see more and more companies focus on AI, which also then in return means that if you're thinking about a deal, if you're thinking about exiting the company, you need to have that addressed. You need to make sure you have an AI roadmap, and you need to build AI into your overall company operations. I think that's what it comes down to these days, and very much looking forward to see more and more companies in our pipeline that follow those rules, and it's going to be exciting.
Great, thank you. Ksenia, any closing comments or thoughts?
Yeah, I think it's definitely exciting for the buyers, for the sellers. This whole AI market is maturing. I would think that the cybersecurity and security of the AI companies' innovations and the tools would definitely be one of the top priorities, and we all need to keep this in mind as these technologies get introduced across multiple verticals, industries, and businesses.
Excellent, thank you. Krista, some closing thoughts for us?
Yeah, what I would add, so many sellers, of course, are rightfully focused on a deal structure and valuation and how does that impact their outlook. But sometimes I think that one of the most powerful things a seller can really do is envision, how would you tell the story to your clients regarding a potential sale of your company? How are you going to articulate the value proposition to your people? And oftentimes it's those threads of strategic alignment within that messaging that really leads a seller to the optimal home for their organization to continue to scale and realize the vision that they initially set forth to achieve. So I would encourage everyone to have a bit more of a forward-looking view, while of course the base economics are incredibly important.
Thank you so much. And Satish, some final comments?
Sure, thanks. AI, we've been living it and seeing it is still evolving, and my only submission would be not to look at AI for AI's sake, but think of it more in terms of a utility, and to really be able to take advantage of what the underlying technology, in this case AI, is able to do to everyday living, whether it's professional or personal. And it really needs to be ubiquitous. So any acquisitions that are being planned as a buyer or that you're building as a business, I would submit that everyone builds with the context of not focusing so much on the technology itself. It's important. But how does it help transform even small parts of our life, whether personally or professionally? Because those have a profound impact in terms of penetration, adoption, enhanced by the amount of value that you create. And completely agree with Krista's point on the forward-looking transparency from a founder standpoint, which, I'd echo back to the first point that I made, saying having an idea about what you want to do as you progress down the journey and how we will message that, obviously, to clients and all of the other stakeholders should be part of, the foundational thinking when you set up or in the very early stages of setting up a company.
Well, great. Thank you very much, everybody. I really appreciate your time today, your participation, your insight.
To our audience, we appreciate your participation today. Visit wfs.com for more information on events coming up. If you'd like to get in touch with the WFS team, speakers, or the Corum Group, email us at info@wfs.com.
World Financial Symposiums, the education center for tech leaders.